the Dividend ETF holy grail of income investing? This Dividend ETF has changed dividend investing forever. For years, I've been obsessed with high-income ETFs. You know the ones, those funds promising juicy monthly payouts, often north of 10%. They've exploded in popularity, becoming a core holding for countless income investors chasing passive income and financial freedom. And among them, covered call ETFs have always been a staple on this channel. Now, if you're part of the family here, you know the basic formula. These ETFs generate cash flow by selling call options on their underlying holdings. That option premium? It gets funneled right back to us as dividends, a beautiful stream of tax-efficient income. This isn't just theoretical. It's real cash flow that acts like a financial cushion, smoothing out volatility and making it easier to dollar-cost average into market dips. Especially when those dividend payments hit your account every single month, or even every week. But here's the catch, the dirty little secret no one really talks about. There's a trade-off. These funds often sacrifice growth. By selling those call options, they put a cap on how much upside the fund can capture. So yes, you're collecting that sweet income, but often at the cost of capital appreciation. That's why I've always hammered home one golden rule. A great covered call ETF must sell out-of-the-money options. That strategy gives the fund room to breathe, room to grow, while still generating that vital income. Simple, right? But what if that rule was completely wrong? What if there was a way to break it and still come out ahead? Today, we're diving deep into an ETF that's rewriting the rulebook. GPIQ, the Goldman Sachs NASDAQ 100 Core Premium Income ETF. And what they're doing is frankly revolutionary. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Part 1. Unpacking GPIQ, a new breed of income ETF. Let's kick things off by getting under the hood of GPIQ. This fund, launched in October 2023, is still relatively new, but it's already making waves with over $1 billion in assets under management. That's a huge vote of confidence, signaling high liquidity and easy access for investors. Currently, GPIQ boasts a dividend yield of around 10%, putting it right in line with other major high-income ETFs like JEPQ. But here's where it gets interesting. Since its inception, GPIQ has returned a staggering 53%. Compare that to JEPQ, which returned around 42% in the same period. That's a significant difference in investment returns. Even more impressive, GPIQ has shown an equal ability to minimize downside volatility compared to JEPQ. Think about that for a second. It's capturing more upside and providing similar downside protection. If you look at their total returns against JEPQ and even the QQQ, GPIQ is carving out its own unique path right in the middle. But how? Both GPIQ and JEPQ deploy a covered call strategy on the very same index, the NASDAQ 100. So, what's their secret sauce for achieving superior investment performance? My first thought was, aha, they must be selling options further out of the money to allow for more growth. But that didn't make sense given their identical dividend yields. If they were giving up that much premium for upside, the yield would be lower. So, my next assumption, they must be distributing more of their capital appreciation as dividends, which would hurt their price return. But again, I was wrong. Their price return, which excludes those dividend distributions, is actually better than JEPQ's. And to top it off, GPIQ even has a slightly lower expense ratio at 0.29%. Though a quick note, that's temporarily waived, and it will eventually tick up to 0.35%. Still, a competitive fee for a fund delivering these results. Part 2. The secret sauce. How GPIQ reimagines covered calls. Okay, back to GPIQ. So, how does this fund achieve such impressive investment returns while also minimizing volatility? It's still a covered call ETF that holds stocks within the QQQ index and sells call options against them. In fact, their underlying holdings are very similar to JEPQ. But here's the twist, the game changer. Unlike most covered call ETFs, GPIQ isn't selling out-of-the-money call options. They're actually selling at-the-money call options. Now, if you've watched my previous videos, you know my stance on this. I'm typically against funds that sell at-the-money call options. Why? Because it completely restricts the growth potential of the underlying assets. You end up relying solely on income generation for your returns. Funds like QYLD or XYLD are prime examples. They sell at-the-money call options on 100% of their assets, and you can see how significantly they lag compared to funds that sell out-of-the-money options. But GPIQ added their own ingenious twist to this investment strategy. You see, while funds like QYLD and XYLD sell call options on 100% of their assets, which is a real problem when using an at-the-money strategy, GPIQ is different. Imagine you own 10,000 shares of QQQ. If you wrote call options on your entire position, you'd sell 100 contracts, since one call option represents 100 shares. Simple. But for GPIQ, instead of selling call options on the entire 100% of its assets, their fund managers are strategically selling at-the-money call options on only 25% to 50% of its assets, averaging around 35%. And this is effective for two brilliant reasons. First, uncapped growth potential. The fund leaves roughly 3/4 of its assets free to appreciate in value without any cap. This is huge for capital appreciation. Second, maximized premium income. Selling at-the-money call options naturally generates significantly more premium income than selling out-of-the-money call options. So in essence, the fund managers are capitalizing on high levels of premium income, in line with what JEPQ collects, but they're doing it by using a much smaller portion of the fund's assets. This is genius because it dramatically impacts their total investment returns, their ability to minimize volatility, and even helps explain their lower expense ratio. Part 3. Let me give you a clear picture of the difference between at-the-money and out-of-the-money premiums. The amount of income you receive from selling just one at-the-money call option is significantly higher than what you get from selling out-of-the-money calls. To earn the same premium as a single at-the-money call, you'd need to sell 136% more contracts at 1% out of the money. That's more than double. At 2% out of the money, it's 190% more contracts, nearly 3 times as many. And at 5% out of the money, a staggering 640% more contracts, over 6 times as many. While these numbers can vary based on market conditions, this example was pulled directly from a real QQQ options chain a few months ago, and it powerfully highlights the steep trade-off when choosing out-of-the-money strikes just for upside potential. So, PIC's fund managers are strategically using a small, specific percentage of the fund to sell at-the-money call options to hit their desired income target, which aligns with other high-income ETFs. Meanwhile, they're leaving the vast majority of the fund untouched, allowing it to appreciate without any cap. This brilliant approach allows GPIQ to capture more upside potential while still effectively minimizing volatility. And their strategy clearly works. GPIQ has captured more upside than JEPQ, and when you compare their total investment returns since inception, GPIQ is visibly ahead. In my opinion, they're managing their investment capital incredibly effectively and efficiently. This intelligent use of capital also explains why they can charge a slightly lower fee, even if temporary, because they're selling fewer options contracts overall, reducing trading costs. Part 4. Consistent income and tax efficiency, the GPIQ advantage. Beyond its unique strategy, PIC's dividend distributions are remarkably consistent. This predictability is a huge win for income investors and retirees who rely on their investment portfolio for passive income. It makes tracking your cash flow so much easier, unlike JEPQ, whose distributions fluctuate monthly because it uses something called ELNs, exchange-traded notes. Another major advantage for investors is PIC's tax-efficient dividend yield. A significant portion, over 90%, is distributed as return of capital. Now, if you've watched my detailed video on return of capital, you know the drill. But for a quick summary, return of capital is essentially returning a portion of your original investment back to you in the form of a dividend. Crucially, because this isn't considered actual income generation, it's not taxed when received. This means the dividends you get from GPIQ are tax-deferred, and you don't pay taxes on them immediately. Now, just to be crystal clear, if you're investing in a Roth IRA, the classification of dividends or return of capital doesn't matter at all. All dividends and capital gains are tax-free upon withdrawal because Roth IRAs are funded with after-tax dollars. The classification only matters if you're investing in a regular taxable brokerage account or a margin account. Similarly, if you're investing in a traditional IRA, return of capital also doesn't really matter, because anything you withdraw from a traditional IRA is subject to your current income tax rate, regardless of whether it was dividends or capital appreciation. Circling back to return of capital, that tax advantage doesn't last forever. As you receive these returns, your original investment, or your adjusted cost basis, ACB, gradually decreases. For example, if GPIQ has a 12% dividend yield and you invested $100,000, in year one you might receive $12,000 in return of capital dividends. Your ACB of $100,000 then drops to $88,000. In the following year, if you collect another $10,000, your ACB goes down to $78,000. This continues year after year until your adjusted cost basis eventually hits zero. This is something you must track yourself. It's incredibly important to remember. At that point, you've essentially gotten back all of the money you originally invested, and remember, none of those distributions were taxed. However, once your ACB hits zero, every further dividend distribution will be taxed as capital gains indefinitely. Part 5. My final thoughts regarding GPIQ and other high-income ETFs. So, in conclusion, GPIQ has truly put a very interesting and effective twist on the covered call strategy. Instead of selling out-of-the-money call options like most of the covered call ETFs I'm typically a fan of, it's selling at-the-money call options, but on a very small portion of the fund. This allows them to capitalize on high levels of income premium, while simultaneously allowing the vast majority of the fund to capture high levels of capital appreciation. In my opinion, this unique investment strategy could enable GPIQ to outperform other high-income ETFs over time, making it a compelling option for investors seeking both income and growth. While QYLD is also a fund I'm a fan of, its strategy is very different, making a direct comparison difficult. What are your thoughts on PIC's innovative approach? Have you considered a fund like this for your investment portfolio? Let me know in the comments below. I read every single one. If this deep dive into dividend investing and passive income strategies was helpful, please hit that like button to support the channel. And don't forget to subscribe for more insights into wealth building, financial independence, and navigating the exciting world of ETFs and stock market investments. Your journey to financial freedom starts here.